But here at Amelia Island, you've told people that you're a little nervous about where we are after 500 basis points of increases, and you'd like to see how the economy is going to evolve, which everybody's sort of taking as you're suggesting a pause in June. What would it take to get you to go the other way? Inflation's still high. Would it take much to convince you to vote for another rate increase?
I don't get into the hypothetical, and I haven't committed or decided anything. I think it's a mistake for us to commit our decisions weeks before the meeting when we're still going to get a lot more information. As I say it, I'm just like an old-fashioned data dog, and the past evidence in the data has been that when you have financial stresses like the bank stresses we're going through now, and when you have big rate increases that take a while to have their full impact, you at least want to take those into account when you're looking at landing the plane. I think the good news is you've seen some of the froth, taken the froth off in the labor markets. We've so far been doing pretty well that job vacancies are coming down without the unemployment rate going up, and the overriding goal is let's get the inflation back to target without generating recession. That's what I want, and that's kind of the Fed mission.
Well, you said that you almost dissented at the last meeting, but you were persuaded to go along. Was it a close call?
I didn't say that I almost dissented. Someone asked me, was it a close call? And I said, yes, I think. For me, I can't speak for anybody else, but for me, I felt it was a close call. 2 meetings ago, the data had come in, was looking pretty hot. We hadn't had any financial stresses, and the argument for the improved, let's call it the improved economic outlook in the SEP was making people a little anxious on the side of how much inflation might still be stored in there. Then 1 meeting ago, before this past meeting, we got the bank stresses and incorporated that into our plan. So at the last meeting, you had not seen yet in the data and in my conversations with financial market and bank participants, you had not yet seen credit crunch taking place in the data. So I felt that at the end of the day, staying on the plan that we had outlined, knowing that there was going to be some bank stress, did make sense. Now you've seen more slowing coming in. You've seen even numbers that were relatively strong, like retail sales. They were lower than expected, and if in nominal terms retail sales were up 0.4%, but inflation was up 0.4%, it's worth remembering, that what actually matters is the real economy.
When the Fed raises interest rates, banks always tighten their credit standards and loan demand goes down. So are you or the people in your district seeing something worse than what ordinarily would have happened?
Yeah, that's an important point to make, that one of the mechanisms of monetary policy when you raise the interest rate is lending standards go up. It's harder to get credit. Businesses choose not to borrow as much because borrowing is more expensive. That's the key. That's the fundamental question: is there a reason to think that the financial conditions are tighter than just what the interest rate says? In previous times of bank stress, they definitely have been. And if you look at the senior lending officer opinion survey put out by the Fed, as rates went up, you did see tightening before there ever was the bank stress. But we definitely need to get a handle on how much on top of the interest rates this is doing. And you've seen throughout the market numbers that range from what would be the Fed's fund equivalent of this bank stress kind of the lowest you've seen is that it's the equivalent of another 25 basis points. And there's some saying it's like 100 basis points, 150 basis points increase on top of monetary policy. So if that does some of the work of monetary policy, you just got to take that into account.
Well, speaking of the work, you guys are focused entirely on inflation and bringing it down, but we haven't seen a lot of movement. After a quick drop from 9 to around 5, we haven't seen a lot of movement in inflation. Are you convinced that you've put enough restraint on the economy?
I don't know if we've put enough restraint. That's what we got to watch. Inflation is down and continues to make progress. It's not as fast as we wanted it to, or we expected it to be, and therein lies that's the nub of the issue of, can you get it down more without starting a recession? Because we have a dual mandate. We got to look at employment and inflation by law, both, not just one. I think you've seen goods prices already come down as we shift back to spending our money on services. Housing inflation hasn't come down yet, but we expect it to because of the components. It kind of moves with a lag. And then this question of services has been more persistent than we thought it would be. But you've seen some prices coming down in that space as well. So I think those things, plus the fact that inflation expectations have remained pretty well anchored, tells you there are at least some forces that are going to keep moving in that direction.
Well, your background suggests that you care a lot about employment, and obviously it is one of the mandates, as you mentioned. Do you think that the data that we're seeing now, and you could include retail sales today, industrial production, suggests that the soft landing scenario is any stronger than it had been?
So, any more likely, you mean?
Any more likely?
Strong? Yeah. I'm definitely hopeful in that there's one group that looks at the labor market and that its prized measure of tightness is the vacancies to unemployment ratio. And that ratio hit record highs, and it's come down a lot. It's still, the level is still higher than it was before, but it's come down in a way that hasn't tanked the labor market. The danger, of course, is if you get a recession and you try to land the plane nose down, tends to be that the labor markets, when they deteriorate rapidly. The unemployment rate goes way up, you see layoffs, and everybody's trying to avoid that, if at all possible.
You probably would see, if you looked at a spread, that you've been put by Wall Street on the sort of the dovish side at this point, whatever a dove means these days. What would you say to the idea of rate cuts, in the sense that Wall Street is already thinking that you're probably going to have to do that by year end?
Look, Mike, the thing is, I've said, the very first speech that I gave is when I took over at Chicago, emphasized, I'm not a fan of setting monetary policy based on what the market says or try to predict how the market's going to react. I think the overwhelming thing that the Fed's got to do is pursue the dual mandate. It's about the real economy. It's about inflation, which is too high, but at least we're making progress, and is about the employment mandate, where the job market remains quite strong. And so I think it's far too premature to be talking about rate cuts, and premature to be saying, even for the next meeting, are we going to pause? Are we going to raise? Are we going to cut? We got to get as much data as we can, and it behooves us at a moment where we followed the strangest business cycle in history, with one of the strangest credit conditions that we've seen in decades. We got to look at a lot more measures than just unemployment, inflation, and wages, and the kind of the conventional box of numbers that we looked at in the past.
Well, you get your next meeting is June 14th. The next CPI report is June 13th. Can we call you up in the Fed meeting room and ask you what you think? Austan Goolsbee, thanks very much for joining us today. The president of the Chicago Federal Reserve.